All right. Good morning, everyone. We'll quickly begin in a couple of minutes. But before that, a quick intro about us and the host today. So we are Team Tradl AI. We are building an AI intelligence trading platform. We have started by rolling out an AI stock screener, which is available on our website, tradl.in. Some of us who have joined today are also part of our platform and a community that we are building. So those who have not been part of the community or have not explored our platform, we'll definitely try to give you the directions to follow us and check out the product in the comment section in a few minutes. Meanwhile, a quick intro about Dhiraj Sinha sir, who is going to be the host today. So before we begin, I just want to understand. Okay, there are people who are not mute.
Yeah, I think it will mute. I am getting an echo.
Okay. Is it fine now?
Yeah, seems fine. Yeah.
All right. So before we begin and discuss quickly about today's session and what we are building, I just want to quickly know from everyone, where is everyone joining us from? Which city are you joining from? Please try to put a comment so that we know how many cities we are covering, where all people are coming in from. We know Dhiraj sir is based out of Bangalore. We are also based out of Bangalore. I'm sure there are more cities that we have reached. Okay. Shama ma'am has joined from Kolkata, Gaurav ji from Mumbai, Shriram sir from Bangalore, Pune, Chennai, Bhagalpur. Nice. A lot of cities.
Yeah, very Bhagalpur nice. Is where I did my high schooling. So good to see someone joining from Bhagalpur.
Yeah. I'm also from Bihar, so good to see people joining in from there as well. Kusmakar sir is joining us from Bangalore, Manu from Delhi, Sumit from Chandigarh. Nice. All right. One more quick question. I also want to know from everyone what kind of a trader you are. If you are a stock-based trader or you do derivatives in terms of FNO as well, just write in the comments, because today's session is going to be focused on futures and options, primarily options, because Dhiraj sir, who is the expert today, has had a long journey and history trading into options. All right. So just comment in the options. What kind of trader do you do? Trading do you do? Are you a stock-based trader or intraday swing trader or an FNO trader? For FNO folks also, would love to understand if you're a buyer or a seller. That would help us understand what kind of people have joined us today, and accordingly, the session content will also have some flavor of what kind of a trader you are. All right. Cool. A lot of people do FNO. Very interesting to see traders joining this session. Kusmakar ji does mostly stocks, long and medium term duration. All right. Ovesh is a seller. Abhishek is also a seller. All right. Very nice. Very nice. Okay. Just one last question. What is your main primary broker that you use? If you use Tide, Grow, Upstocks, any other platform that you primarily use for your trading and investing purposes, please mention the primary broker that you follow. All right. Zerodha, Anurag uses Kotak. Interesting. All right. Zerodha, Angel One, Axis Direct, Define Edge, Sensible. All right. All right. All right. Okay. Thank you so much. That is super helpful. Now we have a lot of context of how many people have joined, where are they joining us from, what kind of a trader you are. Are you an investor or a trader? And in trading primarily, do you do options and futures? And you are a buyer or a seller? We are getting to know that from the comments. And we also now know what are the major brokers people are operating on. Now a quick intro about today's session. Let me quickly share my screen so that everyone gets to know who we are going to host today and what is the session going to be about. All right. So I'm sure a lot of people have seen this session being about an options trader's playbook. So quickly telling you about the expert who's being hosted today. He is Mr. Dhiraj Sinha. He's based out of Bangalore. He's an IIM Calcutta alumni. He has operated for more than 8 years trading options. Just a second. Yeah. I hope my screen is fully visible. Yeah. So he has operated for more than 8 years into FNO. He has also seen a lot of changes in how the markets have evolved, how sellers were making a lot of money up until 2021, and how the regime and regulatory changes have evolved the market structure. What are the things that today work? What are the things that worked in the past? So we are going to cover a lot of that in today's session. A quick intro about myself also. I'm the co-founder of Tradl AI. We are building India's first AI trading platform. We are currently live in a beta mode. So a lot of people who have already explored our platform know that we have released an AI stock screener. We have a couple of also tools currently being tested by different groups of people in pilot. We have an AI stock pattern recognition engine. So across all time frames, we detect all the geometric patterns such as falling wedge, rising wedge, channels, triangles, rounding bottom and stuff like that across all time frames on an FT 500 universe as of now. So this is one tool which is being currently tested in pilot. We've also rolled out a new tool called Smart Chains. So we are trying to reimagine how option chains can be customized by different traders for their different setups. So if somebody who has joined onto the platform but has not got access to some of these products which are being tested, you can let us know in the comments and we'll start reaching out to you and we'll start gradually adding you to the cohorts that we are currently testing these products with. So quick coverage about today's session. So we're going to cover a lot of stuff about how Dhiraj sir operates in terms of his own trading strategy. What are the things that he has learned over the years in terms of managing your psychology as an F&O trader. We'll also deep dive in terms of understanding how volatility also works as an oscillator. How can you monitor VIX and try to base your strategies on the basis of that. And also we'll touch upon the risk management aspects for an F&O trader in terms of your strategies. If they don't work out in your favor, how do you make adjustments to those strategies? How do you roll up? How do you reduce your risk? How do you hedge it? And when to exit? So we'll cover all of this today. It's going to be an action-packed session today. We have a lot of people joining in. Apart from this, I would now want to quickly know if some of the people who have joined us are already using Tradl AI and some of the people who are not using, just please say yes or no. So if you are a Tradl AI user, a part of our early community, our beta user community, please mention yes. If you're not a part of the product, our platform, and not using it, please mention no. We'll reach out to you separately. We'll also keep sharing the product details in the comment section while we continue the webinar today. All right, so a lot of people are there. A lot of people are also not there. So interesting to see a lot of new people have joined us. I think without wasting another time, I would let Dhiraj Sinha, Mr. Dhiraj, take over. Dhiraj sir, I'm pinning your screen so that everyone will be able to see you.
Sure.
All right, over to you, sir.
Great, thank you. It's always exciting to talk to fellow traders. And thanks so much, Nilesh and the Tradl team to invite me and give this opportunity to talk to them. Typically, I don't make many videos because it's very time-taking and I did want to make some regular things. I wanted to make things which are more useful and in-depth. So this is a good opportunity to talk to all of you. We can try to keep it interactive. Yeah. Can we just mute all the participants, please?
Yes, sir. The
Tradl team. Yeah. Great. So I will not take too much time. I think Nilesh gave the intro. So I graduated from IIM and then I wanted to be a fund manager. Things didn't work out. As you know how the placements happen. I got into IT industry, worked there in some very big and marquee names like Infosys, Dell, and my last job was with Capgemini. And that is when I realized that probably, I can relive my dream when I was almost going to be closer to 50. And I started trading option by chance. And that was something which gave me a lot of confidence. People say that option is very risky instrument. And we all know the statistics, 92% people lose, etc., etc. But personally, I found that option is a great way to manage risk. Option is something which gives me confidence that we can trade and we can ensure that there are no major losses if we do it properly. Anyway, I'll talk about some of that. But in this session, I wanted to mainly focus on index options. And I wanted to talk about how do I look at my trades in index options, right? So with that, let me share my screen and I will get started. You will have to tell me once you are able to see my screen. Just give me 1 second. Yeah. Yeah. Hope you are able to see my screen.
Yes,
Can
sir.
anyone give me a feedback? Is my screen visible?
Yes, sir.
Yes, it is
Visible.
visible.
Yeah. So now, just 2.5, 3 weeks back, I have launched an AIF Cat 3 fund. Now, AIF Cat 3 fund is the closest to any SEBI approved fund, which is like a hedge fund. So long, short, and index trading, all that kind of stuff, which one can do, I'm doing. These are not high frequency trades. These are medium to low frequency trades. And is a SEBI approved fund called QuantGro Equity and Derivatives Fund. And I founded a company called QuantGro Wealth Management. That's what I've been doing. So I'm formally having a fund which is approved by SEBI. Okay, and we have launched just on 24th of June. Before I start, I want to give a disclaimer because I'm also SEBI approved and I run a fund. So there are many restrictions that I have. So whatever I'm talking about, please don't consider that as any strategy advice or advice to buy, sell, or hold. These are only for information and education purpose. And I cannot give you personalized advice. I run a fund. I can manage a fund, but I'm not a research analyst or RIA. Any investment comes with its own risk. While I talked about my belief that options are great instrument to manage risk, please be aware that majority, and that number is definitely upwards of 90% people lose money in options. So one has to be fairly knowledgeable and do it with all the caution which is warranted. I have no liability in case you go ahead and based on whatever I'm talking here, takes and trades, and if you lose money, I don't take any liability on that. And that is why I'm saying take it as a framework, take it as a concept. Don't take it as a ready-made food which you can immediately consume, and do your own research. So with that disclaimer, let's begin. Okay. So I just use Dil Tham Ke Baithiye. We will start. So I think Nilesh talked about various things that I'm going to cover. I may not cover everything because we have maybe another 45 minutes or so. But we will start with something which is very simple. And many of you would be aware or would be running that strategy. I wanted to just highlight a simple strategy. And that's what I said. Let's begin with some low volatility. But then we will get into more complex scenario. And that is what I'm calling the gamma blast will happen. So there is something for everyone. If you like things simple, I'm starting with that. But if you want to get into more complexity, I will touch on that, right? So with that, let's get started. Now, this is a simplest of all, right? We are aware of time-based strategies. And this is a very simple time-based strategy. I will tell you what exactly it is. But essentially, we try to get into a non-directional trade because at the very moment when the market opens, we are not aware which direction the market will go. But typically, we have seen that the volatility is high when the market opens and it reduces as the things settle down most of the time. We also know from statistics that most of the time, the Nifty, and this is specifically for Nifty as an index, Nifty remains in a range of say 0.8% or 1% and closes the day with that. We also know that as we come close to the expiry, there is a higher impact of theta decay. So if you are selling an option, essentially we are shorting volatility, and I will talk about that. And we are also trying to gain from the theta. So the best day for an option seller is when the volatility declines and when you are able to capture theta, right? Of course, the market regime has changed and we have talked about that. But this strategy is a simple time-based strategy. As soon as the market opens, earliest algo you can fire at, say, after a minute, 9:16. And the reason of not waiting is that initial period, if the market settles, which happens more often than not, then there is a significant decline of volatility and the options decay because of the reduction in volatility. And you hold the trade for as long as, towards the end of the day, of course, with some safeguards in place, so that you also realize theta decay and you run it 3 days, so 2 days to expiry, 1 day to expiry, and on the day of the expiry. So don't run it on the 5th day of expiry or the 4th, because the theta decay will not be meaningful. And in fact, those days there could be, if the volatility increases, then it may even run into loss. So the point is not, I will show you the exact strategy as well, but the things which I wanted to highlight, this has a win percentage of 71.19%, right? And if you look at the expectancy ratio, that is what shows you, win to loss kind of scenario. This is 0.25. So ideally, you should run things which are greater than 0.2, 0.25. Of course, anything positive will give you positive expectancy, but we know that there is a difference in the backtest and the real trades. So just keep these numbers in mind, right? The expectancy is the most important. Of this particular strategy, there is an expectancy of 0.25. Okay, let's leave it at that. Now, this one is a non-directional option selling strategy. Now, let's move to the next strategy. Okay, now this one is a directional option selling strategy. So the first one, which I said, immediately we go and sell a strangle. You can also sell a straddle. Straddle and strangle, the difference is straddle is the same strike for the put and the call, and strangle are both OTM. I mean, that's the difference. And now, in this strategy, if you see, this strategy has a lower win rate of 61.32%. Okay, and I talked about the expectancy. This expectancy is also lower. This is 0.11. So the previous strategy, which was a non-directional strategy, our expectancy was 0.25. This one, you are waiting for the first 15 minutes. Basically, you are waiting till 9:30. And whichever side the underlying moves, so Nifty breaks the 15-minute range, you go and sell a put option if it goes up. And if it goes down, breaks down the 15-minute range, then you go and sell a ATM call option, right? So this is what this strategy is. And this has an expectancy ratio of 0.11. The previous one had an expectancy ratio of 0.25. Now, with that, what do you expect when we combine these two strategies? Anyone wants to take? I mean, do you think that the expectancy will go up, go down? Because one strategy has an expectancy of 0.25, another one is 0.11. Okay. So I'm not very sure if I can hear the feedback, but probably that's not, this kind of Google Meet is not so amenable to that. But let me just
it's a mix. We are getting a mix of up and down. Most people are saying up.
Okay. So you think that the expectancy will go up. Okay. A drawdown will reduce. Great. So the concept, right? So just one second, I think. Okay. So now if these are the two strategies, of course, I mean, I have taken the brokerage and the charges as well here. So that's why you see 0.28 and 0.14. So this middle one is the non-directional option selling strategy. The rightmost one is that ORB, which is also an option selling, but it is a directional option selling strategy. When we are combining these two, then our expectancy is going up to 0.36. Okay, so that is the advantage of combining strategies. Can you tell me why that is going up? Because these two strategies are giving you diversification due to what? They are giving you diversification due to not being correlated. Okay, so if I just look at the statistics here and I look at the correlation matrix, so these are the two strategies that we are running. I can show you one more stuff, but right now these two are running in the same quantity. 50% allocation on this, 50% allocation on that, right? Now, when you are analyzing this, you would analyze, for example, this return over maximum DD is 2.5 to 8.05, slightly coming down. Expectancy is definitely going up, right? Our risk to reward ratio is also improving from 0.79 to 1.13 when we are doing 50% allocation. Now, the reason is this correlation. you see the correlation. Both are option selling strategy, but they have 0.08 as the correlation. When you are selecting strategies to run, please keep in mind that ideally the correlation should be less than 0.3. So less than 0.3 is good because they're weakly correlated. 0.3 to 0.6 is okay, but they will move in the they won't give you as much diversification as the ones which will be less than 0.3. And anything greater than 0.6 are, you might as well run just one of them, right? They will not give you the diversification benefit. Okay. Now, the same thing, you don't have to really, we saw that if I just look at these two strategies, this strangle, which we are running at the open of the market, seems to be slightly better, right? Because we are getting, this data is from 1st of January 2025, right? So on one lot, we are making 1.46 lakhs. We have a win rate of 71%. So this is looking a little better than the range breakout, because obviously range breakout is directional. You need to take faster decision. But I think I think you will get the gist. But assume that I increase, I don't do equal allocation on these two, right? And I do 2:1 allocation. Of course, I can show that's not the purpose, but if I do that and I run the backtest again, you will realize that the expectancy will further go up. So I'm just giving you a framework. I'm not saying that you run these two strategies or they are the best. Of course, just a disclaimer, the first one, which is the strangle at the beginning, is something which I run pretty much on a daily basis on my fund as well, right? So if you see, this has smoothened the equity curve, okay? And now we just have 1 month of loss out of all the months since January 2025. And our expectancy ratio has further gone up to 0.4. So from 0.35 or I think 0.37, whatever it was, our expectancy further improved to 0.4 if we are running into 2:1 ratio. So the point I'm trying to make is that even a simple strategy, nothing can be simpler than this. You are not taking any decision. You're not looking at option chain. You're not looking at charts. All you're doing is coming in the morning, activating two strategies. One is non-directional, which runs at 9:16, which is just a minute after your market opens. Run it 3 days a week. You're not even running 5 days a week. And the other one is a directional, which gives you that diversification. And combined, you are getting a pretty decent return. And in fact, in this one, I have even factored the brokerage and taxes and charges, and we can even put some slippage. Still, the return will be decent, right? So the point I'm making is sometimes the simple also works as long as you look at it intelligently. I mean, why not just run the full quantity of the non-directional? The reason is that there would be days when the losses will be bigger, and that dents the trader's psychology. That is why it is important to diversification. So I will stop here. Just in case you are interested, I can just explain. You just go and at 9:16 sell 4 OTM put and a call. And then you keep a leg level SL of 1% on each leg. This is what the strategy is. Okay. So the reason I'm talking, so you give the stop loss on the underlying, and that is 1%. Now, earlier when the volatility was lower, say in 2024, etc., even if this was 0.5%, it was working beautifully. But since the volatility has gone up and we know that we need to capture the theta decay, we are now going with the wider stop loss. Now, of course, there are many modifications that can help here. One point I would like to highlight, I always place the stop loss on the basis of underlying movement. I don't like placing stop loss on the basis of premium movement, because I have seen that the premium movement can have those sudden spikes even without the spike happening in the underlying. I also like to wait for minimum 1 minute close rather than trading on every tick. So these are some of the practices which I follow. Of course, something may work better for you, but personally, I have found basing your stop loss on the underlying movement rather than the premium movement is one of the good practices. And waiting for at least 1 minute close rather than tick by tick is a good practice for a non-directional short volatility, or when I say short volatility, that is option selling strategy. Now, things could be different when you are playing of a different type of strategy. Okay. So with that, I will just add one more point. I talked about diversification. Let me go back to my presentation for a moment. Oh, okay, so this is what it was. And the ORV was 15-minute range. I already explained the concept. 9:30 is the earliest it can take the trade because it is looking at the range from 9:16 to 9:30. And then it has 0.5% stop loss on each leg, 0.5% movement of the underlying, which means if Nifty goes up 0.5% and we had sold a call option, it will hit the SL. It goes down 0.5%, but we had sold the put option because there was a breakout on the upside when we were entering the trade, it will hit the SL. So these are the two strategies. Once again, it is just a concept. I'm not saying that you go ahead and just run this strategy and you will be very profitable, right? So with that, that's an important point. Let me go back to my slide. So we saw that we combine. Maybe in some other time, I will talk about the diversification. In this case was possible because one of the strategies were directional, another were non-directional. You can also achieve directional if something is a buying strategy and a selling strategy. You can achieve diversification by having different instruments. For example, you have some strategies running on Nifty. You have another strategy running on Bank Nifty. That will give you a diversification benefit. But one of the things which many people miss out, that there is a great diversification benefit that you can achieve when time to expiry is different of your strategies. For example, if we are running an intraday strategy and a monthly strategy and something which is 3 months or 6 months away, even though all of them would be non-directional, let's say I am just selling strangle. Okay, now of course the strikes would vary, but I'm selling a strangle which is intraday based on the weekly expiry. I'm having positional trades which are based on the monthly expiry and selling a strangle, and then I'm having longer term trades which I will hold longer, but based on say December expiry. Right now we are in July. Even though all three are strangle, short strangle or iron condor, and all three are on Nifty, they will not be very highly correlated. So that's another thing I would like you to, another thought I would like you to leave with. Yeah. So that covers my low volatility part of the presentation. Okay. Now let's increase the volatility. Any question anyone has? If
yes, sir, there are a lot of questions. First of all, there's a request from Hemant if we can use a mix of Hindi and English. I'm sure there would be more
mix of what? Sorry,
Hindi and English.
Oh, okay, okay.
Yeah. I think remaining questions are Jaspreet has asked 2 questions. Do you do directional runs on all days, and how do we choose the strike price of the strangle?
Correct. So for the strike, the strategy which I showed was 2 OTM, but there are different ways. You can always do it on delta. For example, you can say that we will sell 40 delta option on both the sides. So you select 40 delta on the put, 40 delta on the call. The one which I showed you is based on 4 OTM. So 200 points away from Nifty because each strike is 50 points. So when I say 4 OTMs, 200 point away. That is for the non-directional strategy. For the directional, I am selling the ATM because I'm taking a directional bet here. But again, you can select. See, the consideration is, if you want, what is the framework? If you come closer, you will collect higher premium. But at the same time, your chances of breaching that strike also goes up, right? So keep in mind that in option trading, we have to always estimate the probability of 2 things. The first probability is that the strike which I have sold, what is the probability of that strike expiring in the money? That is the probability number 1. The probability number 2 is that if it expires in the money, how big is going to be my damage? How big is going to be my loss? That is the probability number 2. And both the probabilities are factored in the option pricing model. If you go deeper in the Black-Scholes model, you will see that they use 2 probabilities. And these are the 2 probabilities that they use. So hope I'm answering. Now what happens if you're selling closer strike, your chances of that strike going in ITM is higher, right? And again, the losses could be bigger. But the days it doesn't happen, right? Let's say that probability is 60% or 50% if it is, let's say, ATM. But the remaining 50%, when your view goes right, your wins are also bigger. So your MTM fluctuation will be bigger. You will win bigger, you will lose bigger. You have to answer this question psychologically as well, that am I comfortable with that? Same thing reverses if I go OTM. So there are strategies very far OTM, right? And I will talk about that briefly, which can give you consistent return, but they will give you say 7-8% per year, but your win rate would be as high as 95%, 97%, etc. Whereas if you're targeting higher returns, say 25% or 30% per annum, your win rate may come down to say 55%, 58% kind of thing. Now you have to answer what kind of trader are you? Depends on various things, right? How much money you're putting, what is the net worth, in general, what is your psychological build? So long answer, but I think many factors determine the strike selection. As a rule of thumb, if you are selling an option, you sell OTM. If you're buying an option, you buy ATM or ITM. But again, it depends on various situations and some of the complexities I'm going to talk. Yeah, back to you, Nilesh.
There are more questions. I think what we can do is because there are a lot of questions pouring in, we can do a quick 10-15 minutes Q&A for all the people who have open questions towards the end. Let's cover because we have a lot of things to cover.
Yeah.
We'll do Q&A at the end.
Great. But keep your questions, okay? So now I'm getting into a little more complexity. I talked about 2 very simple strategies, right? You actually don't have to worry too much. But the challenge happens that there are days like yesterday when the non-directional strategy could have lost almost, say, 1% of, it lost about 3,000 rupees, okay, yesterday on one lot. So even if you were deploying one lot for 3 lakh margin, that would be 1% loss. So we also want to do something which is more intelligent than just selling a time-based strategy. And that is where I have a framework. So as I mentioned, I sell that non-directional thing, but for the directional, I have my own framework. And there are other trades where I use the framework that I'm going to talk about. So I look at 3 things. And when I trade index options, these are the 3 important elements that I look at. So one is I try to look at the price and determine whether it is bullish, bearish, or sideways. Now that view could be wrong, but I have a process to tell me that given the current setup, do I see Nifty being bullish, bearish, or sideways? I will briefly touch on how I do it. You can apply any system. Some people follow moving averages, some people follow CPR, some have pure price action. So different techniques. So all have their own merits and there may be some shortcomings. But you follow whatever is working for you. Answer the question that based on your method, do you think Nifty is bullish, bearish, or sideways? So that's the first aspect. The second aspect, and even more important, is the volatility, which I have written at number 3, but it's in fact the number 1 for me. The volatility tells me, should I be selling option or should I be buying option? So just a bit of background. When I started trading the option, I was mainly an option seller. Like many people who got in that time, it was easier, the decay was linear, etc., etc. I started in 2017. Many more people came in 2020 during COVID. Luckily, I was already there. But of course, I mean, those days I was having a job and I was not able to devote a lot of time. So I used to sell far expiry options, and I was an option seller. What I realized was that as the more and more participants entered into the market, that easy money by selling an option was becoming almost non-existent. We all are aware of Jane Street and the injection candle and all those spikes, etc., etc. I will not get into complete detail. But the volatility increased because there is no free money in the options market. When that happened, something which I started noticing was volatility behavior. Because I started noticing that many times before Nifty moves, the premium used to start showing an upward trend. The premiums used to start going up. So I will see Nifty is pretty much where it was, but I have sold a strangle and now my losses are increasing. That made me wonder why my loss is going up if Nifty is not moving much. I have sold a strangle. I'm delta neutral at the beginning. That time there may be some small delta bias, but the losses are going up. And that observation, that was almost very soon after Jane Street started. That observation made me deep dive into volatility aspect. So now I start with volatility. I start with, do I think that the volatility is going to go up or go down? Where it is it the time where I should be selling an option, which is the credit strategy, which means I receive premium, or I should be buying an option? So this is very important and I'll talk about that. And the third thing, the third pillar is the option data. Because when I look at the option chain, what is it showing? It is showing what are the market participants doing. The market makers, what are they doing? The other institutions and the retailers, what are they doing? So things like gamma positioning, things like open interest and how that is moving. All that tells me the behavior of the market participants, which essentially tells me that whatever reading I have on the price and the volatility, is that getting confirmed by the options data? So these are the three things I look. So price tells me where the market wants to go. Option tells me the conviction in that reading. I'm saying bullish and I see that more call writing is happening. Then there is a problem. It's not in sync. But if I see bullish and more put writing is happening, I see it is bullish and I expect it to go up with a tearing hurry. And I see that the gamma regime is negative, gives me more conviction. So that's what the option data tells me. And if through the volatility, I'm seeing that I'm getting good premium where my risk is getting paid for, I would sell an option. But if I'm not getting sufficient premium for the risk I'm taking, I will buy an option. So these are the three things. Now the question is, all good, how do you determine that, right? So I will go to the charts, okay? Because I'll go one by one. So first I will talk about the price. The second, I will talk about the volatility, and then I will talk about the option data, okay? So I look at not only the underlying chart. Typically, I look at underlying chart, I look at the put option chart and the call option chart. And then I try to make sense, and this could be ATM put or ATM call, or it could be OTM, but similar delta of put and the call. So I look at those two charts along with the underlying chart, those three things, and try to discern the market direction. And then I try to combine that with the volatility behavior, which I think is going to happen. Of course, the view can go wrong, and then decide what is the right strategy. Once I have taken the trade, then I put the strategy chart. And then a lot of decisions are done based on the strategy chart. Okay. So that is something which let me explain to you through my setup. Okay. So this is, okay. I think we have another 20 minutes, right? Yeah. Okay. So this is the Nifty underlying chart. And I use CPR, right? This is standard CPR, and I cannot explain in this. The yellow line is the VWAP line, okay? And the CPR, the key thing is these three lines are, this is pivot, this is upper range, lower range, and this is previous day low, then there would be a previous day high, and there would be three support below, three resistances above, is what I look at. Now, the way I look at it, most of the time, I see that how far the price has gone from VWAP and wait for a pullback in case I'm already not in the trade, and on the pullback, try to take the trade. So I'm more, and this is the discretionary model that I'm talking about, right? So you see the pullback, then again, it goes above the VWAP, there would be an entry here, right? This is somewhere here. Now, obviously, all the charts look beautiful in the hindsight. The other thing which I look at from CPR, there are a lot of books written on CPR, but what I look at, I see these levels as important levels where I see markets reacting. For example, you see that even though it was a bullish day, the market faced rejection at this second resistance, came down. When it came to the, sorry, that was the third resistance yesterday. So 1, 2, 3, yeah. Then again at this line, it took the support, went up, and it remained in that range till it went ahead and broke, and it almost tried to reach the fourth resistance, R4, right? So the key is, this gives me some sort of directional bias. Price is above VWAP, price is above CPR, price is bullish, right? You can look at some of the other things. You will, most of the time, you'll see that, these are the reaction points, right? Goes up here, takes support. Most of the time, you see that this here, it is getting a rejection from the previous day low, and then going, despite such a big fall, the resistance was taken at the R2. Again, the purpose of this is not to teach you price action. I mean, teach is the wrong word. All of you are experts. Not to share my view on the price action. All I'm saying is, this is a simple setup that I see, which gives me a view on the price. This indicator that you're seeing, this is a very simple indicator which gives me a sense of volatility. Okay, this is India VIX actually converted into a line chart. Okay, so it's instead of the candle, this is the India VIX chart, and I have used two moving averages, a faster moving average and a slower moving average. When the faster moving average is below the slower, that means there is a bearishness, and the vice versa. So I have color coded it. It is a custom indicator which I have developed. This is India VIX, this row. As you can see, this is a VIX indicator, right? So this I have coded in Pine script. You can see when this is on a decline, when this is red, that means the volatility is going down. And in general, when the volatility is going down, is a good time to sell premium, sell an option. And when the volatility is going up, you should not be on the short side. So this is yesterday's chart, right? 17th July. You will notice that from pretty much from the very beginning, this was the spike in the VIX. And then pretty much the VIX was up till 109, right? This is a close of 106 candle. Till 109, the VIX was up. And I mentioned that yesterday, that algo that I showed you lost about 3,000 rupees per lot. However, if someone would have waited for the VIX to start showing declining trend, and at 109, run that same strangle, okay, and held it till it became green, it would have made about 250 to 300 rupees per lot profit. So even yesterday, when that algo lost, because 916 you're blindly running, and there are days when it will lose, etc. If you would have waited for the VIX, which is in some way proxy of IV, again, there are nuances. India VIX is not the option implied volatility. There are nuances because India VIX considers only the monthly expiries, the same month and the next month, whereas we are trading weekly options. So we have to look ideally at the IV chart. But this chart is easily available on the trading view. That's why I find it easier to just look at in one case. I always look at IV as well. Okay, so you got a sense. So this tells me whether I am whether the IV or the VIX is increasing or decreasing, and what is my view on the market. Okay, and based on that, I decide on the strategy. For example, if the market is bullish, clearly, and the VIX is reducing, then I will go and create a bull put spread, right? I will sell a put and then I will hedge it with another put. I like doing spreads because the MTM volatility is managed in the spreads, and also your ability to be in the trade. Because if you sell a naked option, as soon as the MTM fluctuates, we stop looking at the chart and start looking at only at the premium and take the wrong decision. Whereas if we have hedged that position, then we know our maximum risk and we can stay in the trade till whatever is our actual stop loss that we wanted to do, right? Of course, in the price action, I also look at higher high, higher low, the north rate, etc., right? So that's the first thing. Now, the second element is volatility, and I cannot overemphasize the fact that if you master volatility, you master the battlefield of option trading. This is the crux. Everything else is secondary if you're an option trader. You have to focus on the volatility. Now, how do you achieve that? How do you master? So before we dive deeper, let's just revise the basic of what the volatility tells us, right? I'm sure many of you know, but some of you may not have even thought it that way. So we say that IV is 15%, right? That is how we describe. What is the meaning of 15%? So one is, this is the yearly measure, that in a year, the option premiums are anticipating 15% move either way in, say, that particular instrument. Let's say that is Nifty. So Nifty IV for a particular strike is 15%, means for that strike, whatever is the option premium is factoring 15% move in Nifty in a year. Okay. Now, what is the probability of this 15% move? Again, difficult to get the feedback, so I will answer. So is it like, if IV is 15%, do I say that 90% of the time the probability is 0.9 that Nifty will be in 15% range? Or do I say probability is 50%, 40%, 30%? What is that probability? So this 15% tells us this is expected one standard deviation. And if you read the normal distribution, roughly 65% of the data points are within the one standard deviation. So if we are saying IV is 15%, which means that there is 66% probability that Nifty in a year will move within 15% range. Now, if you want to increase that probability to 2 standard deviation, which will give you almost 95, 96%, the probability will go up, then you multiply 15 by 2. So right now, just to take a real example, right? Nifty VIX is 13.2 or 13 point, around that, 30, let's say. So the option premiums are factoring with 66% probability a 13% move in Nifty in the next 1 year, and with 95% probability a 26% move in Nifty in 1 year. So assume that you go and sell a strangle 1 year ahead from now. There is 95% chance that your option will expire worthless, and whatever premium you have collected, you will get. But of course, there is a 5% chance that it will not. So that is the meaning of IV. To be honest, when I started trading and knowing about IV, I had not understood it this way. Okay? Though it is the absolute basic. The other thing is, we are not always going to trade the option which is expiring in 1 year. So I am trading option which is expiring today, or I am trading option which is expiring 3 days, or let's say in a week. So what do? So we take the square root of this and divide it by this, multiply it with the square root of time. So this is 1 year, and you can take, for a sake of simplicity, 254 or 256 trading days. So if you take the square root of 256, that becomes 16. So whatever the percentage VIX or the IV you are getting, you divide that by 16 to make it a round number, and multiply by the square root of number of days in which you are going to keep the trade. Just to take a simple example, assume that the IV is 16 So 16 divided by 16 is 1. And we are going to take an intraday trade where I'm bothered about 1 day volatility. So square root of 1 is 1, which means that when the IV is 16, we are expecting 1% intraday move. If the IV is, say, 20, then you are expecting 20 divided by 16 into 1, which is 1.25% intraday move. Now, if you go to week, we know 52 weeks, so you will take the square root of 52, which will be 7.3 or something. So for the simplicity's sake, say 7.5. Now, if the IV is 15 divided by, and you want to see what would be the move in 1 week, then it would be 2% expected move in 1 week with 1 standard deviation, right? 1 standard deviation move will be that, which is 66% already. So I hope you're getting. So you look at the IV, you divide it by 16, you take the square root of number of days you want to hold the trade, and that gives you expected 1 standard deviation move. You want to be safer, you want to take 1.5 standard deviation, multiply that range by 1.5. You want to be even safer, you want to take 2 standard deviation, multiply by 2. That gives you the range. So that also answers the question which I was saying, what would the strike selection, depending on what you want to do, okay? So I hope this was of some use to you. Then let's move to the next one, right? So what should I do? Should I buy or sell? Now, the one thing you need to look at it is that volatility is mean reverting, but one needs directional confirmation. And that is when Nilesh was saying that volatility is like an oscillator. We know that if the is like Bangalore temperature. We know that if temperature touches 40 degrees centigrade, the rains are imminent. They will come. But sometimes what happens that 40 degrees can remain for 4 days, 6 days, 7 days. Rain will eventually come and the 40 will come down to 22 or 24, which we have right now. But it can remain elevated. So look at 2 things. In general, we know that our Nifty IV will be, say, between 11 to 20. No, I would say 13, 12, 12 to 15 is the normal range. Now, if you start exceeding, if it is, let's say, above 20, then you know that it's a matter of time where it comes back to that 13, 12 kind of number. Now, that is the time when you can sell an option because you are getting a good risk premium. Okay. Challenge is that it can go to 20, it can go to 25, 30, 35. So if at 20 itself you were very happy and sold an option, what happens when it is going up? Your MTM will keep on showing huge losses. So you not only look at the extremes, you also wait for the confirmation of change in the direction. That is where you will have to look at the IV chart or the VIX chart. So confirm is like RSI, very similar to RSI. RSI above 80, we say it is over bought. RSI below 30 or 25, it's oversold. But that RSI can remain elevated. Same behavior is there for volatility as well. So that's the first thing. And so I already described that, correct? So whether it is elevated and whether it is increasing or decreasing. The best case scenario for an option seller is this. If you're selling an option, then the IV direction should be down. The IV percentile. Now we can always convert everything into percentile by looking at the last 1 year data. And that 1 year data tells you whether it is high or low and the direction. So if it is high and the direction is down, with very high conviction, we can sell an option. And that is where we can look at gamma. And I will briefly talk about gamma, but before that, let me finish the buying setup. If the IV direction is up and the IV is low, so IV is low and increasing, best setup for buying an option. IV is high and decreasing, best setup for selling an option. And if you look at the gamma, and I know that in this forum, particularly people who are in Tradl, they are looking at gamma as well. I think, Nilesh, we will have to extend by 15 minutes or so. I hope people will continue. Otherwise, we'll share the recording. So gamma gives me the confirmation See, typically the dealer, what we see, the gamma, net gamma, is short or long. And maybe I will write a tweet on why sometimes it is short instead of long. But just remember this simply. If you see net gamma is long, that's a normal market. When market makers will buy when things go down and they will sell when things go up. So they take opposite, right? So when the market is going up, they will be selling to hedge. And when the market is going down, they will be buying to hedge. And in that situation, when they are following that behavior, the gamma is positive. The gamma exposure is positive, and that's a normal market, which means market will remain, it won't be too volatile. But if it reverses, they are doing the opposite. They're accentuating the move. Market is going up, they're further buying. Market is going down, they're further selling. And why they do it? Because the institutions are behaving a certain way, and the market maker has to provide that liquidity to the institutions or the retailers, and then they have to hedge their position. So if there is a panic in the market, institutions are buying put option. So someone has to sell the put option. Who will sell the put option? The dealer, the market maker is going to sell the put option. As soon as they sell the put option and the market is going down further, how will they hedge? They will sell a future. So in this scenario, what is happening? Market is going down, but the market maker is selling the future to hedge. That will further accelerate the move, isn't it? And same thing when the market is going up, and let's say people are buying call, and this guy has to sell the call. This guy, as in market maker, has sold the call. He has to buy a future when the market is going up. So he's buying when the things are going up, he's selling when the things are going down. It's an imbalance or a volatile situation. So gamma short means you expect higher volatility. So you don't want to be in an option selling kind of strategy. Gamma long, you can go and do an option selling. So this is the volatility behavior. I hope this is making sense. Little bit heavy stuff, but you can look at that. And finally, the game is to forecast the realized volatility, right? So you are getting IV. IV is option premium is factoring that Nifty will move 15%, correct? And on that basis, you are selling an option. Assume that Nifty actually moves 20%, then you are going to lose, isn't it? But if Nifty moves 13%, you are very happy. You are going to win. So whether it moves 13% or 20%, you know only after the fact. So that is called realized volatility when you look back. Now your job is to anticipate what could be the realized volatility, compare with the implied volatility. When IV minus RV is a positive number, you are comfortable selling an option. When IV minus RV is a negative number, then you should be not selling an option even if you don't buy an option. And there are statistical methods like GARCH, ARCH, or now there are machine learning things which look at historic price data, etc. But what if you are neither having a machine learning model nor get into a statistical model? How can you do that? And that's a very practical thing. In my team, every day in the morning, even before we discuss that what we think Nifty will go up, down, or remain sideways, we discuss what will happen to volatility. Do we see the volatility increasing? Do we see the volatility decreasing? And what is the simple framework, right? So I have tried to give a very simple framework. So you need to look at what is the geopolitical situation. Is there any big event? So yesterday, what happened? We know that the bank results are going to come over the weekend. And yesterday was the last day of trading before those big results. So there is an impending event, which means the chances of volatility being high is going to be high, right? We also look at the second thing, what has been the recent volatility trend? Has it been decreasing? Has it been increasing? And volatility also behaves in cluster. So sometimes you will see that when the realized volatility goes up, they don't just reduce the next day. They remain most of the time elevated, and there is a clustering effect. So if we look at what has been the behavior recently, has that typically in the morning, the volatility is high, then it steadily declines during the day. Is that the trend, or the trend is reverse? That's another factor. Look at how big is the gap up down and what is the global market doing. So if there is a bigger gap up or bigger gap down, the initial volatility is going to be high. And then you have to estimate, will that gap get filled? And that is where you look at the price action for the next 10, 15 minutes. So it's very difficult. While in the morning you can discuss and you can create a view, you should wait for 15, 20 minutes to see what is happening. Is the gap getting sustained? Is the gap getting filled? Are we getting wider range candles, one after the other? Are we getting smaller candles? Is the price reverting to mean, or is the price going in one direction? These are the observations. Even if you observe for 15 to 20 minutes, you will have a better handle on the rest of the day, how the volatility is going to behave, most likely. These are all probabilistic forecast. So you look at all these aspects, but do it consciously. See, the challenge is we always look at price chart and we always try to keep on forecasting. Nifty ऊपर जा रहा है, नीचे जा रहा है, Nifty side में है, लेकिन हम volatility को नहीं देखते हैं. We don't look at volatility. In this session, if there is one thing I want you to take away from, just one thing, मैं 1 घंटे से बोल रहा हूं, आप सुन रहे हैं, एक चीज अगर आपको you have to take away, this is the thing. Every morning at the beginning or within the 15-20 minutes of the market open, please think and try to assess the volatility for rest of the day. आपकी view गलत हो सकती है, which is fine, but start doing this. And then you become better and better at it, and you will become much better option trader than whatever you are today. Okay. So this is the key takeaway from the session. Okay. Now, of course, I wanted to quickly show you, and Tradl smart chain is amazing. I'm not saying because I'm in the Tradl. In fact, when I met Nilesh, I told him that it's a very competitive market. बहुत सारे tool हैं, आप क्या कर लोगे kind of thing, right? But when I looked at the option chain, and I will show you that how easy it is to configure. Every tool gives you option chain, but no one, I have not seen, जहाँ पे आप खुद का कॉन्फ़िगरेशन अप्लाई कर सकते हो और ऑप्शन चेन को जिस तरह से देखना चाहते हो वैसे देख सकते हो, वो मैंने नहीं देखा है, वो ट्रैडल ने दिया है. और पहली बार देयर इज अ टूल व्हिच आई हैव सीन इट, एंड दैट इज वेयर माय रेस्पेक्ट फॉर ट्रैडल हैज गॉन अप significantly. But I am talking about skew. So this is, you see the surface, ये कल का volatility skew है, ये परसों का है, and this is 2 days before, right? Clearly you see that all the IVs, right? This is plotting the strike to the IV, okay, of Nifty weekly option. So clearly, this entire thing has moved up yesterday's. Can you see this line? What is it telling us? That in general, the volatility has gone up. Okay. At the same time, this is a normal behavior because put IV is typically higher than the call IV. And this chart, despite all the things which has happened yesterday, despite the up move, the put IV is still higher than the call IV, right? You can see on the left side, you see the put, right? OTM IV. On the right, you see the call IV, which is telling me that there is a high chance that this IV is going to decline come Monday after the event. Market is still behaving in a normal fashion, though the IV in general has gone up. So if someone has taken a spread, a risk-defined strategy, a credit spread on Nifty for Monday, high chances that it will come in the profit unless there are some very, very large moves. So the risk reward was in favor of carrying spreads, non-directional, okay, like an iron condor on Nifty for Monday. Risk reward is in favor. It can make loss. For all we know, something happens. But risk reward was in favor. So that's the point I wanted to make. And yeah, so in summary, trend decides the direction. Volatility helps us to select the right strategy. And option data gives us the conviction. So just remember this. Take a screenshot, we'll share. Direction and volatility. What will I do the direction? Nifty is going up, right? So I can sell a put option, I can buy a call option, I can create a spread. What should I do? How do I determine that? Based on volatility. Should I be buying a call or selling a put? Should I be creating a spread? That is what volatility tells, and the option data gives conviction on our thing. I think I missed one thing which I will quickly cover before I hand it over for the question and answer. So I was talking about the 3 chart setup, right? So as you can see, this is the put option chart, this is the call option chart, this is the VWAP and the candle. Simple, right? You have to look at put and call. Are they in divergence? Means, is the divergence strong? Is the put going up significantly or going down? And is the call behaving in entirely opposite direction? So put is going down, as you can see here. Call is going up. Just one second. This is not in sync, but basically here you will see. Yeah, here. The call going up. Sorry, I did not sync my thing. Just one second. Yeah, but I think you're getting the sense. So put going down, call going up. There is a strong divergence, which means the bullish view is confirmed. But if both are kind of sideways, like here you see, right? This is a sideways move. Then it's more likely a range. So the more divergence between the put chart and the call chart, stronger the trend. So put going down, call going up, uptrend is strong. And if divergence is becoming stronger, then uptrend is becoming stronger and vice versa. But if both are kind of going down, it's a delight of the option seller. Both premiums are declining. And 100% that day, the VIX will be showing like this kind of trend. Okay. So this was on 16th of July, first day, right? So anyway, so that is the first thing. So you determine first whether the VIX is going up or going down, volatility basically. So volatility is going up. Ideally, you should be on the debit strategy, which is the option buying. Volatility going down, credit strategy. Then should you be non-directional or directional? How do you determine? You see if there is a divergence between the put chart and the call chart, and how strong is that divergence. If the divergence is strong, be in the directional option selling. So VIX is declining, put option is going down, call option is going up. You should be selling a put option. Okay. VIX is going up, put option is going down, call option is going up. You should be buying a call option or a bull call spread. So you can put a simple decision matrix. The first thing, if you have a flow diagram, is VIX increasing or decreasing. So VIX increasing, then is put increasing or decreasing, is call increasing or decreasing. If you look at these 3 aspects, you can determine the exact strategy that you will trade. So that is how you determine. So one algo is running, which is statistically thing, and this is more of a rule-based trade, right? So the rule is telling me VIX is going up, going down, put is going up, going down, call is going up, going down, or sideways, right? Put and call. And that, if I feed these 3 things, it gives me the right strategy that I should be executing. Okay. So VIX is going down, put option is sideways, call option is declining. I will go ahead and create a non-directional strangle or a straddle. Once I do that, what I do is I put that chart, that strategy chart. This is my 4th chart, right? So there is an underlying Nifty chart that I showed you. There is a put option, call option. And once I enter, so till I have entered, I don't know this chart, right? Once I have taken the trade, then I am looking at this particular chart and assume that I have sold an option, right? So I have sold, say, 950 put and 350 call, which was the trade on Thursday. Okay. Now what I keep on looking, I remain in the trade as long as we are making lower high, lower low, lower high, lower low. Where this structure is broken, the structure is getting broken here. But if you had already made your money, you can look at 1 minute candle closing above VWAP, okay, and you can cut your position. Okay, so VWAP slope was declining. The VIX was also going down. The strategy was making lower high, lower low. I can continue to be in a trade. When it crossed VWAP, or you can even put a super trend or a moving average, whatever you want to put. When that strategy chart is crossing that, that is how you can trail your SL, right? So I will stop here. Essentially, you are looking at the price action on underlying, which is Nifty. You're looking at the Nifty put chart, you're looking at the call chart, and you are looking at the volatility. These things are telling you which strategy you are running. And if you are in whichever strategy, you then apply that strategy chart. And if you are selling the option, you are waiting for it to continue declining and trail the stop loss. When you are on the buying side, you continue to see that it is going up and trail it. Okay. So that's pretty much it. And that is the time when you want to do an adjustment. It's a complete ball game together. Probably we will have a different session on adjustment and a long dated option. But for this session, I think I have covered what I wanted to cover. Sorry, after the intro, I have taken 1 hour, but from the beginning, I have exceeded by 12-30 minutes, but I hope it was of use. Open back to you and open for Q&A, right?
Thank you so much, sir. I think it has been a very great session. A lot of people have stuck till the end. We have a few minutes. Do you want to quickly show the Tradl option chain, the smart chain that we have developed?
Oh, yes. I will. No, sorry. Good. Because I showed you the skew and I moved. I will just show one thing which I've done. You can show more, but I had something which I really used, right? Is my screen visible? Sorry for missing this. Right?
Yeah, visible.
So see, what I have done is, the beauty of this is that I have built my own template. Okay, and I'll tell you what you don't get other. Can you see here? I have something called 25 delta put IV, 25 delta call IV, and 25 delta risk reversal, which is the call IV minus put IV. Now, this is something which is not there in other tools, or this is not exactly what you also need to do, but I like to see this. Okay, what is it saying? It is showing me, when I keep on looking at that option chain, I'm seeing, whether it is going up, this IV, whether this is also going up or going down. And the more important, if normal behavior, if you recall, what did I say? Put IV will be higher than the call IV, right? In this case, it is there. This is normal behavior. But what if the call IV goes above put IV? This is very important for me. I keep on tracking this number, right? If it becomes positive, then I will not be in the anything which is short. I mean, I will be in the long trade. Most likely, I will be in a long call spread or even a naked call buy. This I was able to do thanks to Tradl, right? Obviously, we look at the OI, and I could not talk a lot about OI because of the paucity of time. But OI and the gamma exposure, etc., are again available. With that, back to you, Nilesh, if you want to show something more on the option chain. Nilesh,
thank you so much, sir.
What do you want to show on the option chain?
Yeah, I think this is super helpful. We can do a quick Q&A first. I think a lot of questions have come in. The session was quite heavy, and let me just go through the questions that have come in. So Jaspreet was asking, how do you choose the strike price of a strangle?
That I have answered.
Yes. Then we had a question from Prasanna. How do you handle the position size? Do you have a max loss for the strangle setup per day?
Yes. I typically look at 1% on the margin, but since I run non-correlated strategies, many times I look at the overall portfolio and wait there. The other thing is that I typically don't apply the full margin. I always keep about 40% margin as the buffer. Yeah.
Got it. The next question is from Priyadarshan. Can we get the proper rules of strategies so that we can run backtest? So I've mentioned that some of the strategies that you showed on AlgoTest are proprietary to QuantGro. So we'll not be able to share that, but the recordings will be shared so that people can take that as an inspiration.
And I am kind of mentioned, so you'll get it.
Yeah. Okay. Pritesh was asking, does time-based selling do better on 0 day to expiry? Would you be able to share your views?
Yeah, typically yes. Typically, yes, because there is decay most of the days, but some days you get stuck. So you need to know how to in those days, cut your position, because the gamma is more pronounced on the 0DT. So it's a higher risk. So reward is there, but it's a higher risk. So you need to have a clear system of when will you cut that position. And those days, I will probably not wait for 1% move. If I see that the volatility is going up, if I see the IV is going up, the premium is going up, I'll cut my position earlier. I also watch the gamma exposure and the gamma flip level and the Y. So what happens some days, right? You see that very closely. Typically, ATM gamma is the highest, and then it decreases, right? So you go from the put option, you keep on going up. The gamma increases, reaches the max at the ATM strike or one strike either side. And then you go further down, you will see that it is decreasing. So in that range, which is the gamma flip range, the market is in that range, but it breaks that range. That is when the volatile move comes. And if that is where even the OI, so just to take an example, Nifty is at 24,200 and the gamma flip range is 24,150 to 24,250. That's the range. That is where you see the maximum gamma. And you also see the high put on 24,150, very high call on 24,250. And market is quiet. You are getting the decay. Your 0DT strategy, which is option selling, is working wonderful. But you need to have a hard stop loss that as soon as that range is broken, you are out of that trade. Yeah, I hope that answers. So reward is higher, but some days you will get host, and that is where you need to know when will you run and take the shelter.
Got it. We have two folks who have raised their hands, Sudeep and Jatin. I'll let Sudeep go in first. Sudeep, do you want to ask anything directly to Mr. Dhiraj? You can unmute yourself.
Am I audible?
Yeah.
Yes, you are.
Okay. So first of all, congratulations, sir. You are launching a new fund. So it's not every day you actually get a chance to learn from a hedge fund manager. Thanks to Nilesh and team. So I have a more of a business technical question rather than just for the technical part. So as you are launching a fund, so are you using have you taken the alpha route membership, or are you going via some prime broker or normal broker route for placing your trades?
No, I am a normal broker, and this fund is a SEBI registered fund. So there are a lot more regulations for a SEBI registered fund in terms of you need a custodian, there are many other aspects that come into play, unlike a retail trader. So
exactly. So the reason I ask is because if you go by the alpha route, I think you won't be able to deploy fully automated strategies, right? Is that correct? I have heard about it. And,
no. I can deploy fully automated. I use a broker and I can deploy it as long as I am within the SEBI exposure norms.
Okay. Yeah. So you can use your in-house tools to completely automate strategies and deploy them, right?
Yes, completely. No restriction on that.
Okay. Because I have talked with a lot of prop fund guys, and they are not actually allowed to deploy fully automated strategies. They have
no. There is no restriction, but we'll move to other questions because I think that there are many questions. But you can reach out to me offline as well.
Sure. Okay.
No restriction for me.
Okay. That was my question. Yeah. Thanks. Thank you, sir.
We have Jatin next. Jatin, you can unmute and ask.
Yeah, Dhiraj, thanks for the opportunity. I just want to know, so you spoke about, how IB or VIX gives us a probabilistic idea of, how many times an index or a stock would remain in that range, right? So just reversing the logic around, and especially for stocks. So for instance, if you talk about two standard deviation, right? Typically 95% of the time we say that a stock index would stay in that range. So let's say if a stock has already made a two standard deviation move, say in a month, then do you also leverage it? So next month, the chances of it making another two standard deviation move is extremely minimal, and it's a high probability trade. So using it in the reverse way to take high probability trades may not be as applicable to index, but
no. I think it's a very good question, and that is what I meant. That when that would have happened, what do you expect IV to be? IV would be elevated at that point in time, correct?
Yeah,
it would have been elevated already.
Yeah.
So IV is elevated. You just wait for the confirmation that IV has started declining, and you get the trade. That's the best trade you can take as an option seller.
Okay, and just one more follow-up question to that. So, since the two standard deviation we talk about is linked to an underlying IV. So you would look at the elevated IV, or you would look at the IV, before the two SD move.
No, I look at the current IV.
The elevated IV. Okay.
Yeah.
Okay.
Yeah.
Good.
And I look at the current IV, but see, that is where your determination comes. Because
Okay.
you are at some level forecasting RV, right?
Yeah. Correct.
So if it is already elevated and you think that RV is going to be much lower, then you can suitably adjust, and you don't have to take 2 standard deviation. You can play with 1 standard deviation.
Yeah. Okay. Got it. Thanks, Dhiraj.
Got it. We have Prasanna next. Prasanna, you can unmute and ask.
Yeah, thanks for the opportunity. Yeah, it's a great session, Dhiraj. So my
Thank
question here is, so when are you doing STBT or BTST? So, I mean, which session you are taking the confirmation to go for the strategy? For example, after 2 p.m. or throughout the day, from the morning to evening, are you analyzing whatever the indicators price action you showed? So, I mean, which is your best conviction, after 2 p.m. or throughout the day for the STBT?
So in general, I definitely look at the closing, right? If it is purely overnight and STBT or BTST. So the closing has higher weightage than whatever happens, and see that how the positioning is at that point in time, right? And what is my conviction there?
Okay.
Yeah.
Thanks.
Yeah, I think someone said, what is RV? RV is realized volatility. So implied is something which we estimate in the option premium, and realized volatility, which actually happens after the fact. Once the day is over, then you know that day what was the movement in Nifty, and through that movement in Nifty, you can compute the realized volatility. So RV is realized volatility, not the recreational vehicle. And sometimes if you just search on RV in Google, we'll get a lot of recreational vehicle photos. Yeah, go ahead.
We have just one more last raised hand from Arka. Arka Deepta Roy, please unmute yourself. You can ask.
Am I audible?
Yes, you are.
Thank you, sir, for the wonderful session. My question was pretty simple. So if we go for manual strategies, and for example, on a good day, like not on the crazy days, how do you think about the target? Do we make it run as much as we want, or if it's like I get 2% in a month or like 1% in a week, I just close shop and sit tight?
So I typically don't stop based on my profit percentage. I look at that strategy, and as I explained, right, if the strategy has a trailing logic, then I trail, and if my trail SL is hit, then I will get out.
Okay, so if the straddle or the strangle makes a higher high or above VWAP, will get out.
Correct.
Thank you, sir.
Or it is a time. If I don't want to carry overnight, then 325, 327, I will exit.
Thank you.
All right. I think we have covered most of the questions. There's just one interesting question Vicky is asking, which is from your tweets. He is asking, can you please explain the Sensex expiry trade where your strangle SL got hit and your call trade got reversed and exited with a gain?
Right. So basically, see what happened that time, the IV went up, right? And clearly, see, market also gives you feedback when you take a trade, and the MTM gives you the feedback. That is your trade going in the right direction or wrong direction. And that is when I saw that it was going in the loss, and I saw that the IV is going up and there is a directional move coming. So I reversed that trade basically. And you know, that's basically a logic which we follow. That IV started increasing. So when IV started increasing, we said we will not be in the short volatility strategy, which is option selling. We'll get into option buying, reverse the trade, and then obviously very fast that move came, right? Which was the right decision.
All right. There was one interesting question from Nitish. He was asking if the TradingView VIX indicator of your PineScript code can be shared. So I've just responded. We are building our own charts. We are building an AI-powered charts. So custom indicators are going to get rolled out. Some of these indicators built by experts like Dhiraj sir will be available on the platform. So stay tuned for that. You can apply for early access on our website, tradl.in. I think we have made a coverage on all the questions. Just a couple of last few questions coming in. Lawrence is asking, do you take hero zero trades? If yes, what do you look at?
So in my fund, I typically don't, but sometimes as a personal trader, so I do. So that's what I said. So hero zero trade has a very, I think you can apply a very clear logic on the hero zero trade, right? So one of the examples, and you would see on, if you go to my Twitter timeline, there's something which I had posted, and in fact, Algo Test guys back tested it and found that it works. So one of the things which I do is on the option mispricing. So after 2:30, if I see that Nifty straddle is say 40 rupees or less, that means 1 hour is left and market is not expecting more than 40 points movement. And there, if I see that, the IV percentile is still above 85, say 88, 89 or whatever, that gives me a very high conviction that the chances that this 40 will become 60, 80, etc. is very high. And you can simply go and buy a straddle because it's so cheap. That is one way. Very quickly, I'll take 1 more minute. The second, little more refined way. So you look at the gamma flip level that I talked about. So it's a range. And you see that price is stuck in that range. And you also see that OI wall, right? There will be very high call OI, say just 50 or 100 points away from where the spot is. And likewise, 50 or 100 points below where the spot is on the put side. As soon as that range breaks, you can take the hero zero trade. Okay, because that gamma moves on the expiry day are fairly volatile, but they're not random gamma moves. The flip level has to be broken. So you need to be aware where is your flip level. You need to be aware where is your OI wall. And if that is breached, it's like a dam, right, which holds the water, but if the dam is broken, then there would be a flood. So if that OI wall is broken, there would be flood. If the gamma flip happens, there will be flood. And that is when the hero zero works the best.
All right, we have Pritesh also with his hands raised. Pritesh, please unmute. You can ask.
Hi, Dhiraj sir. Thank you. The session was insightful. I have a couple of questions. For automation, does algo test work for you, or do you have your own in-house automation also?
So I have a combination. Typically, I use algo test for execution part. And I use my in-house proprietary thing for the decision part. So I have broken my system into 2 parts, decision and execution. So I have not built the execution engine myself, because that's but the decision analytics is mine. So from there, I send the signal for the execution. Let's say my decision says that you execute an iron condor, correct? So once you have the iron condor, there is a strategy level SL, there is a leg level SL, this, that, and all that. That is the execution part. Correct? That I do it through algo test. The decision is mine.
Sure. And also, Dhiraj, that AIF, this question is slightly, on a different topic. You can do all the option strategies in AIF type 3?
Yeah. You can do all the option strategies subject to the exposure norms. That's
right. So then within the fund, then there would be restriction on the type of strategies which can be implemented.
Not on the type of strategy. There would be some restriction on the quantity. Not type. See, if let's say I'm buying a future, right? Nifty futures. With the margin, let's say I can buy 5 lots.
Right.
Correct? But in the fund, I cannot go more than 2x. So I will be able to buy, let's say, only two lots. But I can buy a future. I can sell a future. I can do any strategy I want. There is no restriction on that.
Okay.
The quantity, you have to ensure that it is not exceeding the exposure norms or the leverage norms.
Sure.
Yeah.
Okay. Yeah. Thanks.
All right. Jaspreet, you can unmute. Go ahead.
Yeah. So, am I audible?
Yeah.
Yes.
Okay. So this session was very helpful, and congratulations to you on your recent launch of AIF fund. So my question is regarding the non-directional strategy that you said that you run along with your non-directional strategy. So do you run that on all the 5 days, or do you run out only on the 3 days where you run the?
No, so what the ORB I shared was only for the 3 days, but typically I would be running some directional strategy most of the days.
Okay, and sir, this question is regarding your fund. So which broker have you tied up with for your running this thing?
I would not like to name that in the public forum.
Okay, sir. Thank you so much.
All right, cool. I think we have covered most of the questions, sir. Thank you so much for taking.
There is time. 1 or 2 very quick, I will say. Someone is saying, when can access GEX for a given expiry? I think it is in the Tradl. You can see the GEX regime and you can see that data.
Yes.
I think there is another one. What is the 25 delta and, in the option chain, what is the risk? See, typically 25 is the right OTM option. A rule of thumb is your probability of that expiring in the money is 25% and out of money is 75%, right? I mean, that's rule of thumb. It doesn't behave that simplistically. But 25 is where most of the fund houses, they look at 25 because that's the OTM, because very far will give you misleading picture. Let's say if I go and see 21,000 put option IV, doesn't make sense, right? Because there will be hardly any premium. So 25 is the reasonable compromise where you get decent premium. At the same time, the chances of it expiring out of the money is 75% almost. Yeah.
All right. I think we have now covered all the questions. I'll take a quick 2-minute break, and I will just want to show all the people who have stayed till now in the session and are new to Tradl AI. We would like to show you a quick glimpse of what we have built so far. So just let me know if my screen is visible to everyone. Is it visible? Please mention yes or just give a thumbs up.
We can.
All right. So on Tradl.in, which is our main product, it's currently operating under beta. You will have to apply for early access if you're a new member. What you get is an AI-based stock screener. You can basically do earning reports analysis or natural language-based stock screening in a certain universe. You can add your own watch list that will also act as a universe. So you can put in any natural language prompt, something like this I tried yesterday, stocks that have given recent range consolidation breakout or a strong price trend reversal, and I need only bullish stocks for both the trends. What it does is it quickly converts my prompt into a mathematical execution plan. It codes it out, and then it runs on real-time market data pipeline, and then gives me the final result. So I ran it on a Nifty 500 universe, and it gave me 68 stocks. I can check it in a heat map view. I can check it in a list map view. I can see what are the different signals getting catched in that particular stock. I can see a quick tooltip for the stock chart overview. I can expand the chart. I can do a deep dive on the chart on the stocks page as well. So this is something that we have built as an AI stock screener. We have a discovery module as well, where all the different screens are available, bullish, bearish screens. You can create multiple watch lists from your prompts and save them into a playground, which acts as a dynamic watch list. So I keep watching stocks which are trending out of an EMA cluster or breaking out with certain volume spike, etc. So this serves me as a quick location to go and spot certain opportunities for my swing trading purposes. We also have a market buzz section. So we cover all the news. We try to do an AI analysis on top of it. We detect what all stocks are getting impacted. So this is it. Apart from this, we also have an alerts module, which we have tried to build very differently compared to all the other platforms. So you get a stock overview once you subscribe to any of your prompts. So you can write a prompt, save it, and subscribe it for a certain frequency. The prompt will keep auto running at a certain frequency, and then it will catch how many stocks are moving in and moving out, and it basically plots it on a scatter plot here. And then you get a relative volume slider to identify which are the stocks appearing or disappearing from a particular prompt that you had added and are having certain spike in terms of their price, their volume, or number of screens and signals that they're appearing. So these are some of the stuff that we have attempted. The two pilots that we're currently doing is one on patterns. So we have detected all the geometric patterns across multiple time frames, intraday and multi-day time frames for all the geometric patterns. So you get to see a quick overview of where the rounding bottom is forming at what time frame. And if you want to take a certain trade, you can come and watch this. We also saw the Smart Chain product, which Dhiraj sir is also using currently. The Smart Chain product is basically an AI-powered option chain. So you can use the build feature on the Smart Chain, and you can write anything that you want, be it custom metric, custom rules, or if you want to generate a custom view of the Smart Chain based on the setups that you're interested in, you can just write it as a prompt. I currently have an iron condor setup currently plotted on my option chain screen. It gives you the rules automatically once you write the prompt, and it gives you certain key metrics to track. So these are some of the things that we are building. There are a lot of exciting stuff that we are going to launch separately. Apart from this, we will be launching an AI-powered smart charts, and we have a strategy builder and a backtesting tool coming up very, very soon. So anybody who is interested in exploring this AI-powered trading intelligence stack, you can apply on our platform. It's Tradl.in. Now, thank you so much, Dhiraj sir. Thanks. This was a super helpful and very inspiring session. And once again, congratulations for you for the newly launched fund. We wish you all the best. And I feel this has been the highest turnout session that we have had so far on our expert series. And all the people who had joined us, if you are not on our early believers community, please apply for the access. You'll get to witness how Dhiraj sir also participates in that community and his wisdom nuggets. You will be able to get that, firsthand. So thank you again, everyone. It was a nice Saturday morning. I know it is very, very difficult. We try to keep it on weekends because, Monday to Friday are market days, so we cannot disturb the fellow traders. We'll keep coming back with more and more sessions in coming weeks. So stay tuned, and thank you so much. See you soon.